So this is what we are going to have. For those who are intermediate, it is topic 2. This one is topic 2. The content is the same. But for advanced guys, this one is normally in topic 1. It is a common topic for the two teams, advanced and intermediate levels. Now, the history of audit started like this. In the early 18th centuries, people used to have auditors, just like now. But those auditors were people who would just come, they would just come and watch what is being done. So whenever you do a mistake or make a mistake, the employees will always go to them and explain themselves before them. They are trying to say what happened and why. Then they will make judgment just like judges, right? So that is the auditor that we used to have. Somebody who is just there to listen to what you're doing. So that process of hearing from the Latin word is called audit, or you can call it, that is where the Latin word for audit, that is basically hearing. So the person that used to do that work was auditor. But then when a lot of transactions started coming in, people are doing now business, then they started thinking about the best way of doing audit. Then they realized that instead of just listening to what these guys are doing, can we go and check the figures? Can we be looking at the financials? And so they move from the old way of just listening to what is happening to now doing inspection or investigation of the financials. And so we move to a higher step or another step. Then after that, they realized that audit is not just about looking at the financials. They decided to improve. So they move from that level to another level where they are now looking at more than just financials. They look at what is called operational audit. They look at governance audit. They look at management audit. They look at system audit. So they realize that in an organization, there are more than that. And so because of the need of the nature of transactions that keep on changing, they decided like now, if the financials are kept in a system, then now let's look at the system itself. Let's look at the reliability of the system. So audit is not just examination of the financial statement. Audit is examination of a subject matter. Because when you look at subject matter, it can take any form. The subject matter can be a physical thing, like building, you can audit building. The subject matter can be system. The subject matter can be behavior, like the behaviors of employees. That is also another subject matter. So a subject matter can take any form, right? So when you're defining audit, you can use an examination of financial statement, fine, but know at the back of your mind that we have other audits that do not relate to the financial statements. Now, the popular one that people know is the audit of financial statement, which is fine. But that one refers to historical financial statement. That means that auditors normally come first. Now, accountants normally come first. They keep the book, they prepare the books, the records, then after that, they call auditors. So auditors normally look at the historical financial statement, things that have been done on the previous period. So that is a normal statutory audit. It is examination of historical financial statement, right? But then we also have other audits that are concerned with the future information. That is called PFI. Not historical financial statement, but future information or future financial statement. That is called prospective financial information audit. Or sometimes you call it PFI. That is the one for future. Now, let's now come back to the definition of audit. Now that you have understood the background, we now come back to definition of audit. So audit is about examination of historical financial information by an independent auditor or independent party. That means that for you to be a good auditor, you need to be independent. You need to be free from biasness, all right? So that process of examining the financial statement for historical information by an independent person or professional, so that you can come up with a good conclusion, or you can be able to determine whether the financial statement represents true and fair company's position then that is what now we call audit. I'll repeat again, from definition. From definition, audit is the examination of historical financial information. It is the examination of historical financial information by an independent person. By an independent person with a view or with an aim of coming up with a conclusion on whether the financial statement represents a true position of the company. Why are we saying that you need to check whether financial statement represent the true position of the company? As an auditor, when I'm going to audit, there are some statements that have been prepared by the management. The accountant has prepared the financial statement, and they are claiming that those financial statements are okay. If they are not okay, they will change it. They are claiming that the financial statements are true and represent the company's position. So for that matter, therefore, as an auditor, I'm coming to check whether what they are claiming is true. That particular claim that they are making, we normally call it in audit terms assertions. We call them assertions. Assertions are basically beliefs or claims that management put in place when they call auditors to come and audit. They are claiming that those financial statements are okay. If they are not okay, they would have amended something, right? Normally, when you're going to audit, the management will call you. They tell you we are ready, come. That means that they have prepared everything to the best of their knowledge, and those things represent the true position of the company. It is the truth. So as an auditor, you are coming to check whether they are true so that you come up with a conclusion. And that is what we mean by inspecting or investigating whether financial statements represent true and fair view of the financial position of the company. So as an auditor, I'm coming to check that, right? So that means that we have a responsibility for the auditor, and then there is a responsibility for the management. Of course, as an auditor, I'm coming to check whether it is true. What have been given in the financial statement, what have been given on the trial balance is actually what is on the true position. What is the true position? Yani things on the ground are okay. Najua sasa zingine unaweza ambiwa kuja uangalie kumbe vitu kwa ground ni tofauti. Meaning what they are trying to give you as financial statements and what is there on the ground are different. And so you need to check that things on the ground are the same. So when we talk about assertions, these assumptions that they are giving, these beliefs that they are giving, or claims that they are making, what are they? What are the assertions? All right? By giving you the financial statements, they are assuming some things that everything is okay. What are these assertions? So I want you to look at the assertions that we normally have. By giving you the financial statement, the management are assuming something that you are coming to check. So as an auditor, you need to check those assumptions. They are called ACCA cover. That means that by giving you the financial statement that we are ready to come and auditors, they are saying that those financial statements are accurate to the best of their knowledge. So the first one is accuracy. Now these are assertions in the financials. Accuracy. Number two, they are trying to say that as a good accountant who went through CPA, who is very competent, he is trying to say that the financial statements are correctly posted and they are completely posted. So they are complete. Nothing. Hakuna kitu imebaki nje. Na kama kuna kitu imebaki, they should have actually adjusted. So they are trying to claim that according to them, the financial statements are already complete. Now the audit is coming to confirm the accuracy and also completeness in the financials. They are also saying that they have classified them according to the right classes. So classification, that the financial statements have been classified. Whatever belongs to the PPEs has gone to the PPEs. The current assets are being classified as current assets, and the liabilities are also well captured. So the classification is okay. The reason why it's good to check this, sometimes you buy something like maybe you've gone to buy an item. Remember, both expenses and assets are debited. So you ask yourself, this item, should I expense it or should I capitalize it? When you capitalize, that means that you post it as an asset. But when you expense, it will go down and be written off. So you need to check that this item, if it is book, for example, we have a book that you can be buying. This book can be an expense and it can also be an asset. How? If my business is to run, for example, stationaries like a shop, then this book is an asset because it is a stock. It is used to generate money. But if I am doing another business, I'm just buying the book for doing some 1 or 2 records, then this book should be expensed. So you need to ask yourself as an accountant, am I going to classify them under expenses? This item that I bought, is it an expense or is it an asset? And so that is why, as an auditor, when I'm coming to audit, I need to come up with an audit program, which I'll be able to teach you later. I'll be able to teach you later, the audit program, so that you can be able to see how you should be able to audit each item. When you go to PPEs, how do you audit a program? When I go to assets, how do you audit the current assets, the liabilities, the current liabilities, and even receivables? All right. So those are audit programs. They will be able to tell me how I will be able to check. And first, I need to come and look at the items that you're having. I'll need to get the file and check. You bought the books. What was the purpose of the book? Is it a stock? If it is a stock, I expect you to classify it under assets. If it is just a normal expense for writing some notes or whatever, then it should go under liability, under expenses, right? Now, the second one is allocation. Allocation is quite the same as classification. So you need to be able to allocate them correctly. Okay. For example, when you're looking at the allocations, you can be having some expenses that you need to allocate to each, like overhead. So you need to know that this one has been allocated to the right place, all right? Like overheads. When you're now allocating expenses, you can be distributing them correctly. That is also something that you need to confirm. Then we also look at the cutoff. That is another assertion. Cutoff basically means, and this one is applied when you're auditing the P&L items only. That means, like for example, when you're doing exams, unaambiwa cutoff ya kumaliza mtihani ni saa fulani. When you are booking, for example, you're booking mtihani, there is a cutoff. When you are paying VAT or taxes, they are cutoff. That means mwisho ya kitu, mwisho yake, that is cutoff. And so in audit, P&L items should only be considered. P&L items should only be considered if they are actually belonging or expensed in the year of audit. So that means that end of the year is the cutoff. Zote lazima zikuwe within the period under audit. So that is why when you do audit, at the end of the year you start under P&L, you start afresh. You start posting afresh. The profit that you get, you move to balance sheet item as results. All right, and then you come and start P&L items again. So that means that we need to only include the expenses that were incurred in the year or during the year. We only recognize the revenues that you are entitled to during the year. And so that is what we mean by cutoff. So when I'm auditing P&L item, I want to check that you've not included everything, even the ones that do not belong to this year. I only want to see the ones that belong to this year. As an auditor, you check the cutoff so that expense for last year is not brought forward to this year. It can only come to this year as accrual, but not as an expense. Then we have occurrence. What does this mean? We need to check that transaction actually occurred. It is not like we are supplying power. It actually occurred, it happened. How do you confirm that it happened? Now, when we are given financial statement, they are basically claiming that the financials actually occurred. Hakuna kitu wameforge. And so as an auditor, I'm coming to confirm that. Then valuation, sometimes you are given motor vehicle. Especially PPEs, you need to get their values. So you need to check that the values that you are given in the TB or trial balance are actually the values for those items. And of course, we have audit procedures to check that. Then we have existence. That means that the assets exist. Don't tell me that you have motor vehicle, but it doesn't exist. How do I know that motor vehicle exists? An audit procedure for motor vehicle, for example. How do you know that it exists? I take example of you auditing a company that is claiming that they have motor vehicle. Lakini wakati umeenda audit, the motor vehicle will not be there waiting for you. They are in business. It has gone to Eldoret, it has gone to Italy, it has gone to Mombasa. They are doing business. They can't stop so that you check motor vehicle physical. But how do I know that it exists? I should be able to see in the expenses, motor vehicle running expenses. Ukiniambia kuna gari, lazima nione ile expense ina relate na gari. And that is one evidence that really motor vehicle exists. Kuna gari kwa hii nyumba. Kuna gari kwa hii ofisi. Because I was able to see the expenses. I could see director's fee. I could see fuel. I could see maintenance, replacement, or whatever, repairs and maintenance of motor vehicle. I can see. So when I'm seeing these words, then automatically I know how to become a gari. So that is existence. Then we have rights and obligations. How can I confirm that these people have the rights to own this motor vehicle? Maybe the motor vehicle is for the CEO, but not for the company. So I need to check the title deed. I need to see the sales agreement. All right. Those are the confirmation of the rights and obligations. I want to see the insurance that is actually under the company's name. That shows that the company has the right to own that motor vehicle. But also, they have the obligation, meaning that they have to take the liability in case of any accident of the motor vehicle. Okay, so for those who are joining, I can see the numbers drop, no problem. We are just doing some few free class for audit and assurance. And this is an area that I really like, so don't worry. Okay, so let me look at another area when we are talking about assurance engagement. So audit is type of assurance engagement. Now, what do we mean by assurance engagement? From the word assure, from the word assurance or assuring, what does that mean? This basically means that somebody is trying to raise your level of confidence. Somebody is telling you that, hey, I can assure you I saw them. I can assure you I got this. This person is trying to increase your level of confidence by assuring you. So we have some engagements where the practitioner is expected to give a conclusion. When I talk about practitioner in audit, I'm talking about an auditor. He is expected to give a conclusion that is expected to raise the level of confidence or to increase the level of confidence of the users. And so that is what we mean by assurance. It is an engagement. Engagements are like contracts. You'll be seeing this term many times. So engagement like a contract. When we are having engagement, meaning that to make it mahali. So any job that we are doing together and we have an agreement, that is what we call engagement. So engagement is a contract or an agreement. Now, any job that I'm going to do, which is an engagement, any engagement that I'm going to take, that I'm going to undertake, where as an auditor I'm expected to give a report or a conclusion, and that conclusion is expected to raise the level of confidence of the users. That is called assurance engagement. Non-assurance engagement, you are not expected to increase the level of confidence at all. It is just an engagement where the auditor is not expected to give any conclusion or report that is intended to increase the level of confidence. And so that is the difference between engagement and assurance and non-assurance engagement. In this one, you are expected to increase the level of confidence. In this one, you are not expected at all to increase the level of confidence. So those are the two differences. Now, what are some of the examples of assurance engagement? Example is like audit. Audit of financial statement. When I'm doing audit, at the end of the day, I'm expected to give a conclusion and tell people that whether the financial statements are okay or not, so that they can make the correct decision. Meaning that I'm going to increase the level of confidence. I need to give them information so that they make a good decision. That is called audit. It is an assurance engagement. We also have something like system audit. The same thing, when I'm auditing a system, I need to tell people that this system is okay or not. I need to come up with a conclusion that they can believe it. If it's on a shida, I need to tell them. That means that I'm going to give them opinion on the status of the ground so that they can have confidence on the system or not. We also have review engagement. Under review engagement, from the word review, it could be here. Review. For example, if you are employed and then your boss is telling you, before you send that email, forward it to me so that I can review. What does that mean? Si ati anaifanya, sio yeye ndiye anaandika hiyo email. No, it is you to do it, but he's coming to go through it rapidly. So if I'm an auditor, I'm coming to review a financial statement. I'm not actually auditing. The procedures are the same. Auditing and review is the same. Yani audit ni examine thoroughly, deeply, but review ni kupitia tu juju, because maybe there's lack of time. So I don't have much time to go through everything. I'm just going through it shallowly. I can say that shallowly, or I'm just going through it briefly to check, so that when there is any common mistake, I can easily do. But I'm not going to do it deeper. Now, that kind of engagement, I'm also to review and give a conclusion. When someone is reviewing, is going to give a conclusion whether it is good or not. And Akwambia, go ahead and send. That means that he's going to give you a report or a conclusion that it is okay or not. So these are examples. But we also have examples of non-assurance engagement. These are things that they normally ask in exam. Like in 2019, 2020, they had some questions from the same area. They will tell you differentiate between the two, between this and this, or give examples. All right? So non-assurance engagement. What are some of the examples of non-assurance engagement? Under this, we have something that's called bookkeeping. That is the normal accountancy. An accountant is not an auditor, but auditors are accountants, because you need to understand accounting so that you can audit. Ni kama daktari, lazima uelewe dawa na uelewe ugonjwa ndio uweze kutibu. So as an auditor, I can only know there is a mistake if I understand what is being done. But accountants are not auditors. They don't have the same skills and like auditors. But auditors need to have the same skills as accountants. Now, bookkeeping is the same as the normal accountancy job. You are just coming to use whatever you have, you punch in the figures and you're done. You are not going to confirm whether the financial statements are okay, whether those figures are fake or not. As long as umepewa unaambiwa ndio hii receipt post, you are not going to confirm the accuracy in it. Those assertions, you are not checking whether they are complete, you are not checking whether they are accurate, they are well classified. Wewe umeambiwa ndio hii, enda upost. All right? So you are going to post it by classifying it or trying to check that all of them are posted, but you're not going to check whether they are accurate. You're not going to check the assurance level, whether they are true or not. Where kazi yako ni kuweka by order. Another one is called agreed upon procedure. Agreed upon procedure. This is a situation where the auditor knows how to audit, but then somebody tells you, like, my name is Dennis. So somebody comes and tells me, Dennis, I want you to prepare for me a financial statement that look like this. Why? Because it is for contract. And so the person I'm going to look, who is going to give me the contract, wants it to appear like this. I'm not following the normal audit standard, which we call ISA. This is called International Standards of Auditing. I'm not following a standard. If I use a standard, then I can say that things are okay or not. If I'm actually prohibited or I'm prevented from using the standard, I'm actually prevented from using the standard. They want me to use their own standard, their own procedures. Then I can't take the liability. So I can't give any level of confidence. And that is where we are going to prepare the financial statements, or I'm going to prepare the audit. I'm going to do the audit, not in accordance with the standard that is expected, but in accordance with the standard or procedures that are agreed upon between me and the client. So I'm going to use the procedures that me and the client agreed on. And so that is why it is agreed upon procedures. They are procedures, not the one that is expected, but the one that is agreed on by the client. That procedure could be wrong. It could not be able to give me the correct position. It might not show the exact thing. So that's why I don't take the liability. I don't assure anybody. I don't raise any level of confidence. I just do it and leave it there. So it is non-assurance engagement. We also have tax advisory services. In this one, there is no opinion. Remember, I'm not giving you an opinion. Mimi nafanya tu kazi naenda. So in tax, for example, somebody is coming to tell you, what is this that I'm supposed to do, or how do I file? Like now, somebody has told you to file for me, to file VAT or PAYE. Your job is just come and file. You are not actually coming to give an opinion whether there is any truthness in it. No. Unakuja to file and you go, right? Or you come and tell them, this is what should have been done. But you're not giving opinion. You're using a standard that is well known. You're not coming up with opinion, with your own ideas. Right? So that is a tax consultant. We also have management accounting reports. Somebody might ask you to prepare for them management accounting reports. Those ones you don't give any opinion. Just make for them management reports. Then you leave it at that point. So there's nothing like opinion that you're going to give, right? Those are examples. Those are examples of assurance engagement or non-assurance engagement. Now, how do you know that this one is assurance engagement and the other one is not? So we need to look at the characteristics. In audit, we call them elements of assurance engagement. Symptoms. What can show you that this one is an assurance engagement and this one is not? They normally bring that in exam. In our next class, we'll be able to now look at past paper questions in this topic. We've covered almost around 5 questions that can come from this area that we have covered today. We'll be able to look at them. So what are some of the elements of an assurance engagement? Things that shows you that, or things that must exist in an assurance engagement. So the first one, we agreed that we need to have the auditor. So in assurance engagement, we must have somebody called auditor. We must have somebody who is keeping the books. All right. And so that is the management, or we call it responsible party. Then the third person that we must have in assurance engagement is the person that I'm trying to raise this level of confidence, and that is the user of the financial information. That particular user must be there. Is the person that I'm preparing the report to give. So it could be different from the responsible party. The responsible party is the person who keeps the books, but the user could be different from that person. Think about a circle. We have management in a circle, and then we have shareholders, the people who are investing. They're the ones who want to use the information, but the managements are the ones who are keeping the books. So we have a 3-party relationship or 3rd-party relationship. 3rd-party or 3-party relationship. Three-party relationship. Who are these people? We say that we must have the auditor. We must have the responsible party. That is the person who keeps the books or the subject matter, like accountant or management, must be there. Then we have the user of the financial statement. User of the financial information. Then we have number 2, we have the subject matter. What is being audited must be there. So that is the subject matter. And we say that subject matter can take any form. It could be a system, it could be a procedures, it could be a behavior, right? It could be a financials, it could be physical. Then we have criteria. Of course, when you're auditing, you don't just come and say that this thing is okay and I think this one is wrong. How did you know? There must be a standard. So an auditor will have a standard. This is standard. So we have the actual thing, we have the actual what you are auditing vis-a-vis the standard. So you are able to confirm that this actually is matching the standard, it is okay. This one is not matching, it is not okay. And then of the day you are saying that, okay, according to me, what I'm seeing and what is expected are the same or not. Now, these standards can be policies. If I'm, for example, auditing the procedures, operational procedures, then I need to look at the procedure manual vis-a-vis what is being done, what is actually being done by the employees, and what the procedure manual says. If I'm auditing a HR, I need to look at the HR policies and what the HR is doing. So the policy is the standard, and what they are doing is the subject matter. If I'm auditing a financial statement, I need to look at the IFRS standards, the standards that are being used. We have IFRS, we have ISA, we have IAS, National Accounting Standards. So I need to know that the books have been prepared according to this. Now this one becomes the standard. So that is what we call the criteria. It is the standard. It is the benchmark that I'm using to know whether things are right or not. Then, when I've checked that, how do I know that they're okay? I need to have evidence. So you need to have number 4, evidence, reliable or relevant and appropriate. Or we can say sufficient and appropriate evidence. Sufficient and appropriate evidence, meaning that I need to come up, before I come up with conclusion, I need to have something that is supporting my conclusion, and that is evidence. Then the last thing, I have the report. You need to give a report or conclusion on your findings. Reports or conclusion on your findings. So for today's class, I wish to stop from there. These are the elements of assurance engagement. We have 3-party relationship. These are the 3 parties. We have the subject matter, that is the item under investigation. It's called subject matter. We have the criteria, the standard or the benchmark that you're using to evaluate the subject matter. It is the benchmark or standard that you're using to evaluate the subject matter. Then we have sufficient and appropriate evidence. The evidence must be enough to support what I'm saying. It must be enough in terms of the quantity or numbers. It has to be relevant. It has to relate to the subject matter so that it can come actually give me the correct conclusion. So that means, for example, if somebody tells you, like Sept, for example, today, somebody tells you that, you know, your boyfriend is lying. You normally say that, wacha goja nifanye utafiti, right? I want to investigate, meaning that you're looking for evidence. Until you get that evidence that is sufficient, you cannot come up with a conclusion and say that he is cheating. You need to be very sure. And how do you be sure? How can you become sure? By investigating and also coming up with evidence. And that is why I normally tell my students that audit isn't something that is existing everywhere. You know, 3/4 of the world is full of water, but the rest are auditors. That means that we are all auditors because we always investigate and make judgment every day. There is nothing that you can do without evaluating. Even if you're buying your phone, you normally ask, does it do this and this and this? You are examining, you are evaluating. Then you come up with judgment or confession. That is, and of course, when you're asking whether the camera is clear, you need to compare it with some camera. Which kind of camera are you comparing? That is the criteria, right? The subject matter is the phone. When you are comparing the features, you are comparing with something that you have at the back of your mind. Then we have evidence. You need to tell that person to show you how it works. Tell me if I want to do this. You know, that is evidence you are looking for. And then you come up with a conclusion, right? So these are elements of our assurance engagement, and audit is one of the assurance engagement. Thank you very much. Do you have any question? That is the end of class today.